If you are over 60 years old, you need to hear what I am about to tell you. Because what worked for you in building wealth over the past 30 or 40 years is not going to work in protecting that wealth over the next 3 to 5 years. The investment environment has fundamentally changed. And if you do not adapt your strategy right now, you could lose 30, 40, maybe 50% of everything you have spent your life building. I know that sounds dramatic. I know it sounds like fear-mongering. But I predicted the 2008 financial crisis when everyone said I was crazy. I shorted subprime mortgages starting in 2005. I was mocked. I was called an idiot. My investors tried to pull their money out, and then I was proven right. The housing market collapsed. The financial system nearly went into a depression. And the strategy I had put in place not only protected my investors but made them enormous returns while everyone else was losing their shirts. I am not bringing this up to brag. I am bringing it up because I am seeing the same patterns today that I saw in 2005 and 2006. The same excessive leverage, the same overvalued assets, the same complacency, the same denial. And I am telling you that another major crash is coming. Not might be coming, is coming. The mathematics guarantee it. And if you are over 60, if you are in or approaching retirement, you do not have time to recover from a major market crash the way younger people do. If you are 35 and you lose half your portfolio, you have 30 years to make it back. You can keep working. You can keep saving. You can buy during the crash and benefit from the recovery. But if you are 65 or 70 or 75, you do not have 30 years. You might be living off your portfolio. You might need that money to pay for health care, for housing, for basic living expenses. If your portfolio drops 50%, that is catastrophic. It could mean you run out of money. It could mean you have to dramatically reduce your standard of living. It could mean you become a burden on your children. That is why you need a crash protection strategy. Not a strategy to maximize returns, not a strategy to get rich. A strategy to preserve what you have already built so that you can live out your retirement with dignity and security. Today, I am going to share with you exactly what I would do if I were 60 or 65 or 70 years old right now. I am going to give you the specific steps to protect yourself from the coming crash. I am going to explain why traditional retirement advice is going to destroy you. And I am going to show you how to position your portfolio so that not only do you survive the crash, but you potentially profit from it. Let me start by telling you why I am so certain a crash is coming. I have been studying financial markets for over 30 years. I have analyzed every major crash in modern history. The 1929 crash, the 1987 crash, the 2000 dot-com crash, the 2008 financial crisis, the 2020 COVID panic. And they all have common patterns: excessive valuations, excessive debt, excessive speculation, excessive complacency, and we have all four of those conditions right now. Stock market valuations are at near record highs. The price-to-earnings ratio of the S&P 500 is over 25. Historically, the average is around 16. When valuations get this high, forward returns over the next 10 years are usually very low or even negative. Corporate debt is at record levels, over $10 trillion. Much of it is junk-rated debt issued by companies that can barely afford the interest payments. And those interest payments are about to explode because this debt was issued when rates were at 2 or 3% and now needs to be refinanced at 8 or 9%. Speculation is rampant. People are buying stocks, cryptocurrency, NFTs, meme stocks without any understanding of valuation or fundamentals. They are just buying because prices are going up and they do not want to miss out. And complacency is everywhere. The stock market has been in a bull market for most of the past 15 years, with only brief interruptions. People have forgotten what a real bear market feels like. They think the Federal Reserve will always step in and save them. They think this time is different. It is never different. The cycle always repeats. Boom, bust, boom, bust. We have had the boom. The bust is coming. And when it comes, it is going to be severe because we have more debt, more leverage, more speculation than we had before 2008. Now, if you are over 60, you might be thinking, I have been through crashes before. I survived 2000. I survived 2008. I survived 2020. I will just ride this one out too. And that might have worked before. But there are three reasons why this crash is going to be different and more dangerous for retirees. First, you are older now. In 2008, if you were 60, you are now 76. If you were 50, you are now 66. You have less time to recover. You are deeper into retirement or about to enter it. You cannot afford to wait 10 years for your portfolio to come back. Second, the crash is going to be worse than 2008 because the imbalances are bigger. We have more debt. We have more overvalued assets. We have more fragility in the financial system. When this breaks, it is going to break hard. And third, the policy response is going to be less effective. In 2008, the Federal Reserve cut rates to zero and kept them there for years. They printed trillions of dollars. The government ran massive stimulus programs. This cushioned the crash and supported the recovery. But now, the Fed cannot cut rates to zero and keep them there forever because we just had the highest inflation in 40 years. If they print trillions more dollars, inflation will come roaring back. They are stuck. They cannot fight the crash the way they did before without creating a different crisis. So the crash is going to be worse and the recovery is going to be slower. That is why you need a different strategy. Let me tell you what that strategy is. It has 5 components: capital preservation, income generation, strategic cash reserves, targeted hedges, and opportunistic positioning. Let me walk through each one. Capital preservation means reducing your exposure to risky assets that are going to get crushed in the crash. If you are over 60 and you still have 70 or 80% of your portfolio in stocks, you are taking on way too much risk. I do not care what your financial advisor told you. I do not care what the conventional wisdom says about staying invested for the long term. The long term does not matter if you need the money in the short term. And even if you do not need it immediately, watching your portfolio drop 40 or 50% is going to be psychologically devastating. You are going to panic. You are going to sell at the bottom. You are going to lock in your losses. I have seen this happen over and over again. People say they can handle volatility until they actually experience it. Then they break. So the first step is to reduce your stock allocation. If you are 65 years old, you should not have more than 40 to 50% in stocks, maybe less, depending on your situation. If you are 70, maybe 30 to 40%. If you are 75, maybe 20 to 30%. The rest should be in safer assets: bonds, cash, treasury bills. Now, I can hear some of you saying, but bonds have been terrible investments lately. Interest rates went up and bond prices fell. I lost money in bonds. That is true. 2022 was the worst year for bonds in modern history. But that is because rates went from 0 to 5% very quickly. Bonds got crushed, but now rates are elevated. And if we go into a recession, if we have a financial crisis, rates are going to fall. The Fed is going to cut, and when rates fall, bond prices go up. So bonds are actually going to be a good diversifier in the next crash. They are going to zig when stocks zag. But you have to buy the right bonds. Not junk bonds, not long duration bonds. Short to intermediate term investment grade bonds or treasury bonds. The second component of the strategy is income generation. If you are retired or close to it, you probably need income from your portfolio to live on. You cannot just hold everything in cash, earning nothing. You need yield. The good news is that yields are much higher now than they have been in years. You can get 4 to 5% on treasury bills. You can get 5 to 6% on investment-grade corporate bonds. You can get 4 to 5% dividends from high-quality dividend-paying stocks. These yields are real. They are sustainable. And they can provide the income you need without taking excessive risk. Let me give you some specific ideas. For fixed income, I would focus on short-term treasury bills and notes, 1 to 3 year maturities. You can buy these directly from the Treasury through Treasury Direct, or you can buy them through a brokerage account, or you can buy a short-term Treasury ETF. The yields right now are around 4 to 5%, and they are backed by the full faith and credit of the U.S. government. They are as safe as it gets. You can also look at investment-grade corporate bonds. Bonds issued by high-quality companies like Johnson & Johnson, Procter & Gamble, Microsoft. These pay a bit more than treasuries, maybe 5 to 6%. There is some credit risk, but if you stick to A-rated or higher bonds, the risk is pretty low. For stocks, focus on dividend aristocrats. These are companies that have paid and increased their dividends for 25 years or more. Companies like Coca-Cola, McDonald's, 3M, Johnson & Johnson, these businesses have proven they can generate cash flow through recessions, through crashes, through everything, and they share that cash flow with shareholders through dividends. The dividend yields on these stocks are often 3 to 5%, and the dividends tend to grow over time, which protects you from inflation. You are not going to get rich owning these stocks, but you are going to get steady, reliable income. And in a crash, these stocks tend to hold up better than growth stocks or speculative stocks. The third component is strategic cash reserves. Cash is not trash. I know a lot of financial gurus say that. They say cash loses value to inflation, so you should always be fully invested. That is terrible advice, especially for retirees. Cash gives you optionality. It gives you flexibility. It gives you the ability to take advantage of opportunities, and it gives you peace of mind. If you know you have 2 or 3 years of living expenses in cash or cash equivalents, you do not have to panic sell stocks in a crash. You can ride out the volatility knowing you have a cushion. How much cash should you hold? I would say at minimum 1 to 2 years of living expenses. If you need $50,000 a year to live on, keep 50,000 to 100,000 inches cash or money market funds or short-term treasury bills. If you are more conservative or you see the crash coming soon, you might want to hold even more. 3 to 5 years of expenses. This might seem extreme, but let me tell you a story. In 2005 and 2006, when I was building my short position against subprime mortgages, I was also holding a lot of cash in the fund. My investors were furious. They said I was wasting their money. They said cash was earning nothing and they were paying me to invest their money, not sit on it. But I knew I needed that cash for 2 reasons. First, to meet margin calls and pay the premiums on my credit default swaps while I waited for the crash. And second, to have dry powder to buy assets when everything went on sale. When the crash came in 2008, I was able to buy stocks, bonds, and other assets at prices I never thought I would see. Businesses trading at 30 or 40% of what they were worth. I made enormous returns buying during the panic, but I could only do that because I had cash. If I had been fully invested, I would have missed that opportunity. Same thing is going to happen in the next crash. When stocks are down 40 or 50%, when everyone is panicking, that is when you want to have cash to deploy. You buy when there is blood in the streets, as the saying goes. But you can only buy if you have cash. The fourth component is targeted hedges. Now, this is more advanced, and not everyone needs to do this. But if you want to actively protect your portfolio, you can use hedging strategies. The simplest hedge is to buy put options on the stock market. A put option gives you the right to sell a stock or index at a certain price by a certain date. If the market crashes, your put options go up in value and offset some of the losses in your stock portfolio. For example, you could buy put options on the S&P 500 index. If the S&P is at 5,000 and you think it is going to drop, you could buy put options with a strike price of 4,000. If the S&P falls to 3,500, your puts are worth 500 points. That is a 500-point gain on each contract. You can use those gains to offset the losses in your stock portfolio or to buy stocks at cheap prices. The downside of put options is they cost money. You are paying a premium for the insurance. If the market does not crash, you lose the premium. It is like buying fire insurance on your house. You pay the premium every year. If your house does not burn down, you do not get the money back. But if it does burn down, the insurance pays off and you are glad you had it. Another hedging strategy is to own gold or gold mining stocks. I am not a huge fan of gold as an investment because it does not produce cash flow. But gold does tend to hold its value or even go up during financial crises when people lose faith in paper currencies and financial assets. If you want to allocate 5 to 10% of your portfolio to gold as a hedge, that is not unreasonable. You can buy physical gold, gold ETFs, or gold mining stocks. Personally, I would focus on gold mining stocks because they have more upside leverage if gold prices rise. But they are also more volatile. A third hedging strategy is to short specific stocks or sectors that you think are overvalued and vulnerable. This is what I did with subprime mortgages. I shorted the most toxic mortgage bonds. You could do the same thing today with commercial real estate, REITs, with heavily indebted companies, with overvalued tech stocks, with banks that have bad loan exposure. But shorting is risky. You can lose more than you invest if you are wrong. So this is only for sophisticated investors who really understand what they are doing. The fifth and final component is opportunistic positioning. This is about having a plan for what you are going to buy when the crash happens, because the crash is going to create incredible opportunities. Businesses that are worth $100 are going to be trading for $50 or $60. High-quality dividend stocks that normally yield 3% are going to yield 6 or 7% because the stock price is so low. Bonds issued by solid companies are going to be trading at distressed prices. You want to have a list ready. What are the companies you have always wanted to own but thought were too expensive? What are the high-quality businesses with strong balance sheets, good management, and competitive advantages? Make that list now. Study those companies, understand their businesses, understand what they are worth, so that when the crash happens and the stock price drops to your target level, you can buy with confidence. Let me give you some examples of what I would be looking at. For stocks, I would want to own businesses that provide essential products or services that people need regardless of the economy. Healthcare companies like Johnson & Johnson, United Health, consumer staples like Procter & Gamble, Costco, utilities that provide electricity, water, gas. These businesses do not go away in a recession. People still need their products. They still generate cash flow. They still pay dividends. I would also look at financial companies that have strong balance sheets and are going to survive the crisis. JP Morgan, Bank of America. These banks are much better capitalized now than they were in 2008. They are going to take some losses in the next crisis, but they are going to survive, and their stock prices are going to get crushed in the panic. That creates opportunity. For bonds, I would look at investment-grade corporate bonds that get sold off in a panic even though the companies are fundamentally sound. During every crisis, there is indiscriminate selling. Good bonds get sold along with bad bonds. You can pick up high-quality corporate bonds at yields of 7, 8, 9% when normally they would yield 4 or 5%. That is free money if you have the cash and the courage to buy. Now let me talk about what you should not do, because there are a lot of mistakes that retirees make that are going to be devastating in the next crash. First, do not listen to financial advisors who tell you to stay fully invested and ride it out. The traditional advice is that you cannot time the market, that you should just buy and hold, that stocks always go up over the long term. This advice is designed for 30-year-olds with 40 years until retirement. It is not designed for 70-year-olds who are living off their portfolio. If your advisor is telling you to keep 80% of your money in stocks when you are 70 years old, fire that advisor. They are not acting in your best interest. They are following a one-size-fits-all model that does not account for your specific situation. Second, do not chase yield in risky assets. I know it is tempting. You see a bond or preferred stock yielding 8 or 10%, and you think, wow, that is great income. But ask yourself why it is yielding so much. Usually it is because the market is pricing in a high probability of default. The company is in trouble. The bond is junk rated. And when the crisis hits, that company is going to default and you are going to lose your principal. It is not worth it. Stick to high-quality bonds, even if the yield is lower. A 5% yield that you actually receive is better than a 10% yield that disappears when the company goes bankrupt. Third, do not keep all your money in one bank. The FDIC only insures deposits up to $250,000 per account. If you have more than that, spread it across multiple banks. Or use a service that spreads your money across multiple banks to maximize FDIC coverage. We saw in 2023 with Silicon Valley Bank and First Republic that banks can fail. Depositors with more than $250,000 were at risk of losing money above the FDIC limit. Do not put yourself in that position. Fourth, do not panic sell at the bottom. This is the biggest mistake retirees make. The market crashes. They see their portfolio down 30 or 40%. They panic. They sell everything. They move to cash. And then they miss the recovery. They lock in their losses. If you have followed the strategy I outlined, if you have already reduced your stock allocation, if you have strategic cash reserves, if you have income from bonds and dividends, then you do not need to sell in a panic. You can ride it out. The businesses you own are still generating cash flow. They are still paying dividends. The bonds are still paying interest. Yes, the market value of your portfolio is down, but you are not selling. You are holding for the recovery. And if you have cash, you are buying more at lower prices. Fifth, do not try to time the exact bottom. You are never going to buy at the absolute lowest price. No one can do that consistently. The goal is not to time it perfectly. The goal is to buy when things are cheap and there is a margin of safety. If a stock is worth $100 and it drops to $50, that is cheap. Maybe it drops to $40 before it recovers. So what? You still got a good price. You still have a big margin of safety. Do not wait for perfection. Buy when valuations are attractive and you have conviction in the business. Let me walk through a specific example of how this strategy would work in practice. Imagine you are 65 years old. You have $1 million in retirement savings. You are currently allocated 70% stocks and 30% bonds. That is 700,000 inches stocks and 300,000 inches bonds. Under the crash protection strategy, you would reposition as follows. Reduce stocks to 40%, that is 400,000. Sell 300,000 worth of stocks. Increase bonds to 30%. That is 300,000. You already have that. But you shift from long-term bonds to short-term investment-grade bonds and treasury bills yielding 4 to 5%. Hold 20% in cash. That is 200,000. This comes from the stock sale. This is your strategic reserve and opportunity fund. Allocate 5% to gold as a hedge. That is 50,000. Allocate 5% to put options or other hedges. That is 50,000. This might seem overly conservative. You have reduced your stock exposure by almost half. You are holding a lot of cash. But let me show you what happens in different scenarios. Scenario 1. The market goes up 20% and there is no crash. Your stocks go up 20%. Your 400,000 becomes 480,000. A gain of 80,000. Your bonds stay flat. Your cash earns 4%. Your 200,000 becomes 208,000. A gain of 8,000. Your gold and hedges might lose a bit. Say 10,000. Your total portfolio goes from 1 million to 1,078,000. A gain of 7.8%. Not bad. You did not capture the full 20% stock market gain because you were not fully invested, but you still made money, and you slept well at night knowing you were protected. Scenario 2. The market crashes 50%. Your stocks drop 50%. Your 400,000 becomes 200,000, a loss of 200,000. Your bonds go up 10% as interest rates fall. Your 300,000 becomes 330,000, a gain of 30,000. Your cash is stable at 200,000 plus 4% interest. Your gold goes up 20%. Your 50,000 becomes 60,000, a gain of 10,000. Your put options double. Your 50,000 becomes 100,000, a gain of 50,000. Your total portfolio goes from 1 million to 898,000, a loss of 102,000 or about 10%. Now, compare that to the alternative. If you had stayed 70% in stocks, you would have lost 350,000 on your stock position. Your portfolio would be down to around 750,000, a loss of 25%. By following the crash protection strategy, you lost 10% instead of 25%. That is a huge difference. And you still have 200,000 inches cash plus another 100,000 from your put options. That is 300,000 to deploy at the bottom of the crash when stocks are 50% off. You buy 300,000 worth of stocks at the bottom. When the market recovers to its previous high, those stocks double. Your 300,000 becomes 600,000. Your original 200,000 inches stocks recovers to 400,000. You now have 1 million in stocks plus 330,000 inches bonds. Your portfolio is now 1.33 million. You not only recovered from the crash, you came out ahead. That is the power of the crash protection strategy. You minimize losses on the way down. You have capital to deploy at the bottom, and you maximize gains on the way back up. Now, let me address some specific concerns that retirees have. What about Social Security? Should I take it at 62 or wait until 70? This is a complicated question, and the answer depends on your health, your longevity expectations, your need for income, and your other assets. But in general, if you are worried about a crash, it might make sense to take Social Security earlier so that you have that income stream and you do not have to sell assets in a down market to meet your living expenses. Yes, you will get a smaller monthly benefit than if you waited, but you will have more flexibility with your portfolio. You will not be forced to sell stocks at the bottom to pay bills. What about annuities? Should I buy an annuity to guarantee income? Annuities can make sense for some retirees. They provide guaranteed income for life, which takes the longevity risk off the table. You know you will not outlive your money. But annuities also have downsides. They are expensive. The fees are high. They are illiquid. Once you buy an annuity, you cannot get your principal back. And the income is fixed, which means inflation erodes your purchasing power over time. If you do buy an annuity, I would only put a portion of your portfolio into it, maybe 20 to 30%, enough to cover your basic living expenses. The rest you keep invested so you have liquidity and growth potential. What about real estate? Should I own rental properties or REITs? Real estate can be a good diversifier and income source, but right now I am very cautious on real estate, especially commercial real estate. Office buildings and retail are in structural decline. I would avoid those entirely. Residential real estate is better, but valuations are high, and if we go into recession, home prices are going to fall and rents are going to come under pressure. If you already own rental properties and they are cash flowing well, fine. Keep them. But I would not be buying more real estate right now. REITs are going to get crushed in the crash. Many of them are highly leveraged. When property values fall and interest rates are high, REITs struggle. Their dividends get cut. Their stock prices fall. Wait until after the crash to buy REITs. What about long-term care insurance? Should I buy it? Long-term care is one of the biggest risks for retirees. The cost of a nursing home or in-home care can be $100,000 a year or more. That can wipe out your savings very quickly. Long-term care insurance can protect against this risk. But the premiums are expensive and they keep going up. And if you never need long-term care, you have paid all those premiums for nothing. My view is that if you have less than 500,000 inches assets, you probably cannot afford long-term care insurance. You will likely qualify for Medicaid if you need care. If you have more than 2 million in assets, you probably do not need long-term care insurance. You can self-insure, you can afford to pay for care out of pocket if needed. It is the people in the middle, with 500,000 to 2 million in assets, who should seriously consider long-term care insurance. Shop around, compare policies, understand what is covered and what is not, and factor the premiums into your retirement budget. What about helping my kids or grandkids financially? Should I do that now or wait? This is a personal decision, but financially, it often makes more sense to give while you are alive. You can see your kids or grandkids benefit from the money. You can help them when they need it most, like buying a first home or paying for education. And there are tax advantages. You can give up to a certain amount per year per person without triggering gift taxes. But be careful. Do not give away so much that you jeopardize your own retirement security. You need to take care of yourself first. You do not want to become dependent on your kids because you gave them too much money. A good rule of thumb is only give money that you are absolutely certain you will not need, and make sure you have your crash protection strategy in place first. Let me talk about the psychological aspects of this strategy, because investing is not just about math and logic. It is also about emotions and psychology. When the crash comes, it is going to be scary. The news is going to be terrible. You are going to see your portfolio value dropping day after day. Your friends are going to be panicking. The talking heads on TV are going to be predicting the end of the world. You are going to doubt yourself. You are going to wonder if you should sell everything and go to cash. This is where having a plan makes all the difference. If you have already positioned defensively, if you have already reduced risk, if you have cash reserves, if you have a list of what you want to buy, then you can stay calm. You can stick to the plan. You can avoid the emotional mistakes that destroy wealth. I learned this in 2008. I had spent 2 years building my short position. I knew the crash was coming, but when it actually happened, it was still terrifying. The entire financial system was collapsing. Major institutions were failing. People were talking about the next Great Depression. Even though I was making money on my shorts, I was scared. I wondered if I had underestimated how bad it would get. I wondered if the whole system would collapse and my winning trades would be worthless. But I stuck to my analysis. I trusted the data. I did not panic. and I was able to capitalize on the opportunities that emerged. You need to have that same discipline, that same trust in your plan. Write down your strategy now. Document why you are positioning this way. Document what you are going to do when the crash happens. And when the crash comes, read what you wrote. Remind yourself why you did this, and stick to the plan. Do not let fear drive you to make emotional decisions. Another psychological challenge is dealing with regret. If the market goes up another 20% before it crashes, you are going to regret not being fully invested. You are going to feel like you left money on the table. You need to make peace with this now. Accept that you might miss some upside. Accept that you are trading potential gains for protection. This is the trade-off. You are giving up some upside to limit downside. That is the right trade for someone in or near retirement. Do not let regret cause you to abandon the strategy. Stay disciplined. Focus on the long-term goal of preserving your wealth and maintaining your lifestyle in retirement. Let me also talk about what life is going to look like during and after the crash. Because it is not just about your portfolio, it is about your whole life. During the crash, you are going to see unemployment rise. You are going to see businesses fail. You are going to see people lose their jobs, their homes, their savings. This is going to affect your community. It is going to affect your family. Your kids might lose their jobs. Your friends might need help. This is where having protected your own wealth becomes important. Because if you have protected yourself, you are in a position to help others. You can help your kids if they get laid off. You can help your grandkids with education expenses. You can support charities that are helping people in need. But if you lost half your portfolio, you cannot help anyone. You are struggling yourself. After the crash, there is going to be a recovery, but it is going to be slow. It might take 5 or 10 years for the stock market to get back to its previous high. During that time, you need to have income and liquidity to maintain your lifestyle. This is why the crash protection strategy is so important. It ensures you can survive the crash and the slow recovery without having to dramatically change your lifestyle. You can still travel. You can still enjoy your retirement. You can still do the things you plan to do. You are just doing it with a more conservative portfolio that is designed for the environment we are in. Let me end with this. I know change is hard. I know it is scary to move money out of stocks when stocks have been going up for years. I know it feels like you are missing out. I know your advisor might tell you not to do this. I know the conventional wisdom is against this approach, but I am telling you, the conventional wisdom is wrong. The conventional wisdom said housing prices could not fall in 2006. The conventional wisdom said subprime mortgages were safe. The conventional wisdom said the financial system was sound. The conventional wisdom was wrong about all of it. And the conventional wisdom is wrong now. If you are over 60, you cannot afford to follow the conventional wisdom. You cannot afford to take a 50% loss on your portfolio. You do not have time to recover. You need to protect what you have built. I predicted the 2008 crash. I positioned for it, I profited from it, and I am telling you another crash is coming. The signs are all there. The mathematics guarantee it. The only question is whether you are going to be prepared. I have given you the strategy. I have given you the specific steps. I have shown you the math. I have explained the psychology. Now it is up to you to take action. Do not wait. Do not procrastinate. Do not hope that everything will be fine. It will not be fine. Start implementing the crash protection strategy today. Reduce your stock allocation. Build cash reserves. Focus on income and quality. Prepare your opportunity list. Get your portfolio positioned defensively. Because when the crash comes, it will be too late. When stocks are already down 30 or 40%, you cannot protect yourself anymore. The damage is already done. The time to prepare is now. While markets are still elevated, while you can sell at reasonable prices, while you can reposition without taking big losses. This is not about being pessimistic. This is not about fear-mongering. This is about being realistic. This is about understanding the risks. This is about protecting what you have worked your entire life to build. You have spent 40 or 50 years working, saving, investing. You have built a nest egg that is supposed to support you in retirement. Do not let it get wiped out in a crash that you can see coming. Protect yourself, protect your family, protect your retirement. Let me give you some more specific examples of how to implement each part of this strategy because I want you to have actionable steps you can take tomorrow. Starting with reducing your stock allocation. You need to decide which stocks to sell. Do not just sell everything indiscriminately. Be strategic about it. Sell your most speculative positions first. If you own any meme stocks, any stocks that have no earnings, any stocks trading at absurd valuations, sell those immediately. They are going to get destroyed in the crash. Next, sell your growth stocks that are trading at high price-to-earnings ratios. Technology stocks that trade at 50 or 60 or 100 times earnings, those are going to get cut in half or worse. Keep your high-quality dividend-paying stocks. Keep your consumer staples. Keep your healthcare stocks. Keep your utilities. These are going to hold up better and they provide income. Let me give you a specific example. If you own Nvidia at 140 times earnings, sell it. Yes, it has been a great stock. Yes, artificial intelligence is exciting. But at 140 times earnings, all the optimism is already priced in. Any disappointment is going to cause the stock to crater. If you own Coca-Cola at 25 times earnings with a 3% dividend yield and 60 consecutive years of dividend increases, keep it. That is a quality business that is going to survive the crash and keep paying you dividends. On the bond side, let me be very specific about what to buy. For Treasury bills, go to treasurydirect.gov. You can buy bills directly from the government with no fees. I would focus on 6-month and 1-year bills. The yields right now are around 4.5 to 5%. You buy them at a discount and they mature at face value. The difference is your interest. For example, you might buy a $10,000 bill for $9,750. 6 months later, you get $10,000. You made $250, which is about 5% annualized. If you do not want to deal with Treasury Direct, you can buy a Treasury bill ETF. SGOV is a good one. It holds Treasury bills maturing in 0 to 3 months, essentially no duration risk, and the yield is about the same as buying bills directly. For investment-grade corporate bonds, you can buy individual bonds through your brokerage, or you can buy a bond ETF. LQD is a popular one. It holds investment-grade corporate bonds with an average maturity of around 10 to 15 years. The yield is around 5.5%. Or if you want shorter duration, VCSH holds investment-grade corporate bonds with 1 to 5 year maturities. Yield is around 5%. I prefer the shorter duration because if interest rates move around, the price is more stable. For dividend stocks, let me give you some specific names to research. I am not saying buy all of these. I am giving you a starting list to do your own homework on. Johnson & Johnson, healthcare conglomerate, pays a 3% dividend, has increased its dividend for over 60 years. Strong balance sheet, multiple business lines. Procter & Gamble, consumer staples. Owns brands like Tide, Crest, Pampers, pays a 2.5% dividend. 60+ years of dividend increases. People always need these products regardless of the economy. Coca-Cola, beverages, pays a 3% dividend. Over 60 years of increases. Warren Buffett has owned this for decades. Recession-resistant business. 3M, industrial conglomerate, pays a 6% dividend. Over 60 years of increases. They have some legal issues that have pushed the stock down, which is why the yield is so high. But the underlying business is strong. McDonald's, fast food, pays a 2.5% dividend. 40+ years of increases. People still eat during recessions. They might trade down from expensive restaurants to McDonald's. Realty Income, this is a REIT, so it is a bit different. They own commercial properties and lease them to tenants like Walgreens, FedEx, Dollar General. They pay a monthly dividend currently yielding about 5.5%. I am more cautious on REITs right now, but Realty Income has a very diversified portfolio and they have been resilient through past downturns. Again, do your own research on these. Look at their financial statements. Understand their businesses. Make sure you are comfortable owning them. Do not just buy because I mentioned them. On the cash front, where should you hold it? High-yield savings accounts are paying 4 to 5% right now. Banks like Marcus, Ally, Capital One have competitive rates. Money market funds are another option. Fidelity, Vanguard, Schwab, all have money market funds yielding around 4.5 to 5%. The advantage of money market funds is you can link them to your brokerage account and move money instantly when you want to buy stocks or bonds. For the gold allocation, you have several options. You can buy physical gold, coins or bars. The advantage is you own the actual metal. The disadvantage is you have to store it securely, and there are premiums when you buy and spreads when you sell. You can buy a gold ETF like GLD or IAU. These hold physical gold in vaults and the price tracks the gold price. The expense ratios are low, around 0.25 to 0.4%. This is the easiest way for most people to own gold. Or you can buy gold mining stocks. Individual companies like Newmont, Barrick Gold, or a gold mining ETF like GDX. The advantage is miners have leverage to the gold price. If gold goes up 20%, miners might go up 40 or 50%. The disadvantage is they are more volatile, and they have business risks beyond just the gold price. For the put option hedge, this is where you need to be careful because options can be complicated and you can lose money quickly if you do not know what you are doing. The simplest approach is to buy put options on SPY, which is an ETF that tracks the S&P 500. Let us say SPY is trading at $500. You think the market is going to crash over the next year. You could buy put options with a strike price of $400 expiring in 1 year. You might pay $15 or $20 per contract for these puts. If SPY drops to $350, your puts are worth $50. You made $30 or $35 per contract, a triple or quadruple on your money. But if SPY stays at 500 or goes up, your puts expire worthless and you lose the entire premium you paid. This is why I said to only allocate 5% of your portfolio to hedges. You are buying insurance. You are paying a premium. If the crash does not happen, you lose the premium. But if it does happen, the hedge pays off big and protects your portfolio. Another option strategy is called a collar. This is where you own a stock, you buy a put option to protect the downside, and you sell a call option to finance the put. The call option caps your upside, but it reduces or eliminates the cost of the put. This is more complex, but it can be a cost-effective way to protect a stock position you do not want to sell. For example, you own 100 shares of Apple at $200. You buy a put option with a strike of $180 for $5 per share. This protects you if Apple drops below 180. You sell a call option with a strike of $220 for $5 per share. This caps your gain if Apple goes above 220. The put and call offset each other, so the net cost is zero. You have protected your downside at no cost, but you have given up some upside. Now, let me talk about the opportunity list in more detail. When the crash happens, you want to have specific stocks in mind that you are ready to buy. The way to build this list is to identify great businesses that you believe are currently overvalued or fairly valued. Businesses you would love to own at the right price. For each business on your list, determine what you think it is worth. What is a fair price based on its earnings, cash flow, assets, competitive position, and then determine your buy price. This should be well below fair value. You want a margin of safety. If you think a stock is worth $100, maybe you want to buy it at $60 or $70. That 30 to 40% discount is your margin of safety. It protects you if your valuation is wrong, or if things get worse than you expect. Let me give you an example. Microsoft, great business, dominant in enterprise software, strong cloud business, solid balance sheet, consistent cash flow generation. Let us say you think it is worth $400 per share based on its earnings and growth prospects, but it is currently trading at $420. Overvalued, you do not want to buy it now. But if there is a crash and it drops to $250 or $300, suddenly it is very attractive. You put it on your list. Fair value $400, buy price $300 or below. When the crash happens and Microsoft hits $300, you buy. You make the list now for 10 or 20 or 30 stocks. And when the crash comes, you are not scrambling to figure out what to buy. You are not making emotional decisions in the panic. You are just executing your pre-planned strategy. You are buying businesses at prices you already determined were attractive. Let me also talk about tax considerations because this matters for retirees. If you are selling stocks to reposition your portfolio, you might be triggering capital gains taxes. If you held the stocks for more than a year, it is long-term capital gains. The rate is 0, 15, or 20% depending on your income. If you held them for less than a year, it is short-term capital gains taxed as ordinary income. This could be 22, 24, even 32% or higher. So, if possible, sell stocks you have held for more than a year to minimize the tax hit. Also, if you have any losing positions, you can sell those to generate capital losses which offset capital gains. This is called tax loss harvesting. For example, if you have 50,000 inches gains from selling winners and 20,000 inches losses from selling losers, you only pay tax on the net 30,000. Another consideration is required minimum distributions from retirement accounts. If you are over 73, you have to take RMDs from traditional IRAs and 401ks. The amount is based on your account balance and your life expectancy. If your account balance drops by 50% in a crash, your future RMDs will be lower. This actually can be a benefit because lower RMDs mean lower taxes. But it also means less required income from the account. So you need to make sure you have other income sources or cash reserves to make up the difference. If you have a Roth IRA, there are no RMDs, and withdrawals are tax-free. This makes Roths very valuable in retirement. If you have traditional IRA money and you are in a low tax year, it might make sense to convert some of it to a Roth. You pay tax on the conversion, but then the money grows tax-free and you can withdraw it tax-free in retirement. The best time to do Roth conversions is actually during a crash when your account values are depressed. You are converting at a lower value so you pay less tax. Then when the market recovers, all that recovery happens in the Roth tax-free. Let me give you another real-world example of how this strategy works. I am going to tell you about someone I know. I will call him Frank. Frank is 68 years old. Retired 3 years ago from a career in engineering. He had about $1.2 million saved up. He was allocated 60% stocks, 40% bonds, like his advisor recommended. About 720,000 inches stocks, 480,000 inches bonds. He was living off Social Security plus required minimum distributions from his IRA, about 60,000 a year combined. His expenses were about 55,000 a year, so he had a little cushion. In early 2023, I had a conversation with Frank. I told him I was worried about a crash. I walked him through everything I am telling you. He was skeptical at first. His portfolio had done well. He did not want to sell stocks and miss out on gains. But I pushed him. I showed him the data. I explained the risks. I told him about 2008 and how I had seen this pattern before. He finally agreed to reposition. Here is what he did. He sold 250,000 worth of stocks. Mostly his technology stocks and other high flyers. He kept his dividend payers. His stock allocation went from 720,000 to 470,000, about 39% of his portfolio. He took that 250,000 and put 150,000 into short-term treasury bills and investment-grade bond funds. His bond allocation went from 480,000 to 630,000, about 52% of his portfolio. He put 50,000 into cash, a high-yield savings account earning 5%. He put 25,000 into a gold ETF. He put 25,000 into put options on the S&P 500. He created an opportunity list of stocks he wanted to buy if they got cheap enough. Now fast forward to today, December 2024. The stock market is higher than it was in early 2023. Frank's stocks have gone up, but not as much as they would have if he had stayed fully invested. He is up about 12% on his remaining stock position. So his 470,000 is now about 526,000. His bonds have done okay, up about 3%. His 630,000 is now about 649,000. His cash earned 5%. His 50,000 is now 52,500. His gold is flat, still 25,000. His put options expired worthless. He lost the full 25,000. His total portfolio is now about 1,277,500. He started with 1.2 million. He is up 77,500 or about 6.5%. If he had stayed at 60% stocks and 40% bonds, he would probably be up about 10 or 11% given how the market has performed. So he gave up some gains, about 50,000 to 60,000. He is not happy about that. But here's the thing. He is sleeping well at night. He is not worried about a crash. He has cash reserves. He has his opportunity list ready. And if the crash comes in 2025 or 2026 like I expect, he is going to be glad he repositioned. His losses will be much smaller, and he will have 102,500 inches cash to deploy at the bottom. Compare that to if he had stayed 60% stocks and the market drops 50%. He would lose 360,000 on his stock position. His total portfolio would drop from about 1.32 million to maybe 900,000, a loss of 420,000, and he would not have any cash to buy the dip. Frank's story illustrates the trade-off. You might give up some upside, but you protect yourself from catastrophic downside and you position yourself to profit from the crash. For someone in retirement, that is the right trade. Now, let me address a question I get all the time. What if I am wrong? What if there is no crash? What if the market keeps going up for the next 5 or 10 years? It is a fair question. And yes, it is possible. I am wrong about the timing. Maybe the crash does not happen until 2028 or 2030. Maybe the Federal Reserve finds a way to keep things propped up longer than I expect. Maybe artificial intelligence drives a productivity boom that justifies higher valuations. I do not think any of those things are likely, but I could be wrong. If I am wrong, if there is no crash, you still have a portfolio that is generating 4 to 5% yield from bonds and dividends. You are still earning income. You still have some stock exposure that will participate in market gains. You are just not going to capture the full upside. You might earn 6 or 7% per year instead of 10%. That is the cost of the insurance. But here is the thing. If you are over 60, you do not need 10% returns. You need to preserve what you have. You need income. You need to not lose money. A 6 or 7% return with much lower risk is better than a 10% return with a risk of a 50% drawdown. Because if you take the 50% drawdown, you need a 100% gain just to get back to even, and that might take 5 or 10 years. Whereas if you avoid the drawdown, you can compound steadily at 6 or 7% and end up far ahead. Let me show you the math. Portfolio A is fully invested, earns 10% per year when there is no crash, but takes a 50% loss in year 3. Portfolio B is defensively positioned, earns 7% per year, no crash. Start with 1 million in each. Year 1. Portfolio A is at 1.1 million. Portfolio B is at 1.07 million. Year 2. Portfolio A is at 1.21 million. Portfolio B is at 1.145 million. Year 3. Portfolio A crashes to 605,000. Portfolio B is at 1.225 million. Year 4. Portfolio A recovers 10% to 665,000. Portfolio B is at 1.31 million. Year 5. Portfolio A is at 732,000. Portfolio B is at 1.4 million. Year 10. Portfolio A finally gets back to 1.2 million. Portfolio B is at 1.97 million. You see the difference? By avoiding the crash, Portfolio B ends up way ahead even though it had lower returns every single year. This is the power of not losing money. This is what I learned from studying Warren Buffett. His first rule of investing is do not lose money. His second rule is do not forget rule number 1. It is not about maximizing gains. It is about avoiding losses. Because losses set you back so far that it takes years or decades to recover. Now let me talk about some of the psychological traps you need to avoid. The first is recency bias. This is the tendency to think that what has happened recently will continue to happen in the future. The market has been going up for most of the past 15 years, so people think it will keep going up. They forget about 2000 to 2002 when the market dropped 50%. They forget about 2008 when it dropped 57%. Or they think those were one-time events that will not happen again. But crashes are not one-time events. They are a regular feature of financial markets. They happen every 10 to 15 years on average. The next one is coming. Do not let recency bias fool you into thinking it is different this time. The second trap is confirmation bias. This is the tendency to seek out information that confirms what you already believe and ignore information that contradicts it. If you want to believe the market is going to keep going up, you will find plenty of optimistic analysts and media pundits who will tell you that. You will ignore the warning signs. You will dismiss people like me who are sounding the alarm. You need to actively fight confirmation bias. Seek out contrary opinions. Look at the data objectively. Ask yourself what could go wrong. Stress test your assumptions. The third trap is herd mentality. This is the tendency to follow the crowd. If everyone else is fully invested in stocks, you feel pressure to do the same. You do not want to be the only one sitting on cash. You do not want to miss out. But the crowd is usually wrong at extremes. When everyone is bullish and fully invested, that is when you should be cautious. When everyone is bearish and in cash, that is when you should be buying. In 2007, everyone was buying real estate and mortgage bonds. The crowd was wrong. In March 2009, everyone was selling stocks in a panic. The crowd was wrong. Right now, everyone is complacent and fully invested. The crowd is wrong again. Do not follow the herd. Think independently. The fourth trap is overconfidence. People who have made money in the stock market for years start to think they are geniuses. They think they have it all figured out. They think they can handle volatility. They think they will know when to get out before the crash. This is almost always wrong. No one knows when the crash will start, and when it does start, it happens fast. In 2008, Bear Stearns went from solid to bankrupt in a matter of days. Lehman Brothers went from operating normally to filing for bankruptcy over a weekend. You will not have time to react. You need to position defensively before the crash, not during it. Do not be overconfident. Respect the market. Respect the risk. The fifth trap is loss aversion. This is the tendency to hold on to losing investments, hoping they will recover rather than selling and taking the loss. If you bought a stock at $100 and it drops to $50, you do not want to sell at $50 because that makes the loss real. So you hold and hope it gets back to 100. But sometimes it keeps dropping to 25 or 10 or 0. You need to be willing to admit mistakes and cut losses. If you own stocks that are overvalued or in industries that are in decline, sell them now, even if you are taking a loss. Do not let loss aversion keep you in bad positions. Now let me give you a timeline for implementing this strategy. You do not have to do everything at once, but you should not delay either. Here is what I would recommend. This week, step 1. Calculate your current allocation. How much do you have in stocks, bonds, cash, and other assets? Write it down. Step 2. Determine your target allocation based on the crash protection strategy. If you are 65, maybe 40% stocks, 30% bonds, 20% cash, 5% gold, 5% hedges. Adjust based on your specific situation. Step 3. Identify which stocks you want to sell. Start with your list of speculative, overvalued, or high-risk positions. Within 2 weeks, step 4. Begin selling stocks. You do not have to sell everything in one day. Spread it out over a few days or weeks to avoid moving the market against yourself if you have large positions. Step 5. Start building your bond and cash positions. Buy treasury bills, bond ETFs, move money into high-yield savings accounts or money market funds. Step 6. Buy your gold allocation. Within 1 month? Step 7. Set up your put option hedge if you are comfortable with options. If not, skip this step. It is optional. Step 8. Create your opportunity list. Identify 10 to 20 stocks you would want to buy in a crash and determine your target buy prices. Step 9. Write down your complete strategy. Document why you are doing this, what your targets are, and what you will do when the crash happens. Keep this document somewhere. You can refer to it when you start to doubt yourself. Step 10. Review your plan with your spouse or family, if appropriate. Make sure everyone understands what you are doing and why. Ongoing. Step 11. Monitor the market and the economy, but do not obsess over daily movements. Check in once a week or once a month. Step 12. Stay disciplined. Do not second-guess yourself. Do not abandon the plan if the market keeps going up. Step 13. When the crash happens, execute your opportunity list. Buy the stocks on your list when they hit your target prices. This timeline gives you structure. It gives you specific action steps. It prevents you from getting overwhelmed or procrastinating. One last thing I want to address. What if you are older than 65? What if you are 75 or 80 or 85? The principles are the same, but you should be even more conservative. If you are 75, maybe you should be 30% stocks, 40% bonds, 30% cash, even less stock exposure, even more emphasis on capital preservation and income. If you are 85, maybe 20% stocks, 50% bonds, 30% cash. At that age, you cannot afford any significant losses. You need stability and income above all else. On the other hand, what if you are younger? What if you are 55 or 60? You have a bit more flexibility? You might be comfortable with 50% in stocks instead of 40%. You might not need as much cash, but you should still be more conservative than a 30-year-old. You should still be thinking about crash protection. Because even at 55 or 60, you do not want to take a huge loss right before retirement. The closer you get to needing the money, the more conservative you should be. Let me end by talking about the emotional and mental benefits of this strategy beyond just the financial aspects. When you have a crash protection strategy in place, when you have positioned defensively, you sleep better at night. You are not worried about what the market is doing every day. You are not stressed about losing everything. You have peace of mind. This is valuable. This improves your quality of life. Stress is terrible for your health, especially as you get older. Financial stress can contribute to high blood pressure, heart disease, depression, anxiety. By removing that stress, by knowing you are protected, you are literally extending your life and improving your health. You can also enjoy your retirement more. You can travel. You can spend time with family. You can pursue hobbies. You are not glued to CNBC watching the market ticker. You are not checking your portfolio balance every day. You have set your strategy and you are living your life. This is what retirement should be about. And when the crash does come, you will be calm. You will be one of the few people who is not panicking. You will be able to help your friends and family understand what is happening. You will be able to provide perspective. You might even be excited about the buying opportunities. While everyone else is fearful, you will be greedy, as Warren Buffett says. This is a much better way to live than being in a constant state of anxiety and fear about your financial future. So yes, this strategy is about protecting your money, but it is also about protecting your peace of mind, your health, your relationships, and your ability to enjoy the years you have left. Money is just a tool. The real goal is a good life, and you cannot have a good life if you are constantly stressed and worried about losing everything. Protect yourself. Implement the crash protection strategy, and then live your life knowing you have done everything you can to secure your financial future. The crash is coming, but you are going to be ready. And when it is over, when the dust settles, you are going to be one of the people who not only survived, but thrived. You will have preserved your wealth. You will have bought assets at bargain prices, and you will be positioned for a comfortable, secure retirement for the rest of your life. That is what I want for you. That is why I'm sharing this strategy. Take action, protect yourself, and enjoy your retirement with confidence and peace of mind. The crash is coming. Be ready.